Somebody asked me earlier tonight how I got here. Well, I drove down 280, which is a really long time. But before that, once upon a time, I was in a startup which I discovered was a lot more interesting than graduate school, and so I'm a failed PhD, and probably will remain a failed PhD till death. It'll never happen. I've worked in law, in asset management, and back in startups. And about 4 years ago, started an investment firm for early stage technology companies. And 3 years ago, started an accelerator for particularly for early stage technology companies that is based in San Francisco. And soon we open multiple places in Europe and Asia. So as you can tell, I've spent a long time trying to figure out what I want to be when I grow up, but I think I finally found it. Tonight we have Terri and Prashant here. And Terri, if you would, tell us a little bit about how you got here.
Well, I'm actually looking at being an angel investor as my PhD. I already had my MBA, so I figured spend a few dollars and understand what's going on out in the world. So I am a business person who understands technology. I've spent the last 18 years working in and with biotech, medical device, diagnostic, and digital health companies. And a couple years ago, a buddy of mine, when I was sitting down, I was going, I'm kind of bored with this consulting. I've been consulting for about 12 years, and I work with companies that are 30 to 600 people moving towards commercialization or need systems in place to support commercialization. And he said, why don't you try angel investing? And I'm like, okay. And he introduced me to someone who introduced me to Sandhill Angels, and that was just about 2 years ago. And I thought, well, I'll give it a try. The minimum amount was totally reasonable, and they generally say, hey, don't, give yourself about 6 months, take a look at a bunch of deals before you start investing. Month 1, deal 1. Month 2, deal 2. Month 4, deal 3. So I completely violated all of the rules, but it's super, super fun to see what's out there and to identify technologies and business and management teams that are interesting to invest in. But now I'm investing primarily in digital health, and I focus on investing in female founders and supporting female founders and investors.
Thanks, Terri. Thanks, Kevin. My name's Prashant Shah, and I'm with an organization called Tai. Just out of curiosity in the room here, how many of you have heard of Tai? So a good handful plus, but not everyone. I'll just give you a quick background on myself and then introduce you a little bit to Tai as well. By background, I'm an engineer and ended up doing product management for a number of companies, including large telcos and down to startups. And then after the startup life, I somehow ran into a firm called Hummer Winblad Venture Partners, and they're an enterprise software VC up in San Francisco. So I ended up joining them, and I stayed with them for about 10 years. And when I left Tai, this nonprofit that helps entrepreneurs, they called and they said, well, look, you just left your venture firm, and we have a lot of mentoring that we do with founders, but we don't have a formal way of actually doing investments. So why don't you come and help us figure out our investment strategy? And so I joined Tai, joined their board, and then helped them launch a couple of programs. The first program was Tai Angels, and similar to Sandhill Angels, it's an angel group. The group meets quarterly. You can learn more about it at TaiAngels.com. We invest primarily in enterprise technologies and medical devices. Occasionally, we'll look at consumer as well, but the background of most of our investors comes out of enterprise or medical, and so that's where they tend to gravitate their investments as well. The second program that we had also launched was an accelerator for enterprise companies called Tai Launchpad. We started that. It had a 3-year life cycle on it, which was completed at end of 2016. And so that program has stopped. We've got our portfolio companies that are in Tai Launchpad, but we're not accepting any new companies into that program. In the meantime, Tai Angels continues for all of the entrepreneurs here in the audience or watching us live stream. You can look at TaiAngels.com. Our next meeting is in July, and the deadline for applying for the July window is this Monday that's coming up.
I should probably do a shout out for Sandhill Angels. I'm actually vice president responsible for deal sourcing, and our next cutoff is June 30th for July review and screening at the end of July. So if you go to sandhillangels.com, you can take a look at the select Get Funded, and it'll take you through the application process. I head up the Life Sciences Special Interest Group, so my group definitely takes a look at life sciences. But we have 105, 110 members and really diverse group of investors, and we invest across the board. So while I may focus on a certain area, our angel group focuses across the board.
Beautiful. Well, that's a good kind of a good segue into the first question. You talked a little bit about how you got to be an angel. How do most people enter angel investing? And Prashant?
Well, I think Terry's a great example. Someone who's been successful in technology in some aspect, either as a startup founder or as a corporate executive. And living in Silicon Valley, it's pretty easy to become an angel. You just open the door, and there's always somebody asking you for money or for whatever, advice for sure. And along the way, all of a sudden, you decide this could be kind of interesting. Let me learn more about it. There's no shortage of ways of becoming an angel investor. There are some SEC regulations of what it means to be a qualified angel, et cetera, but you can look that up. In Silicon Valley, it's pretty easy to become an angel investor. The real question, I think, is why do you want to become an angel investor? And I think that may be another part of the discussion, but let me let Terri address your question as well.
Yeah, most of the angels I know are serial entrepreneurs who've had a couple of exits and they've decided to do something different, or they've been, especially in the Valley, they've been successful in whatever endeavor. They've had some sort of an exit and they have extra cash that they decide that they want to go play with other companies with. So I chose to do it so that I could learn more about what's out there. Having been in life sciences, because it's a regulated industry, we are generally really behind the times from a technology perspective. And living in the Silicon Valley and seeing what all of my friends were doing from a technology perspective, I felt like I was missing out. And that's why I call it my PhD, is I saw it as an opportunity to see what else was going on and invest. So it's interesting, in the screening process at Sandhill Angels, I think the membership committee does a really good job in trying to let people know that it is a really high-risk financial endeavor, and the returns, I don't know what the percentages are, but it's relatively low. So if you're going in to really make money and you don't have a lot of extra money to spare going into it, it's probably not a good idea for you. If you have a low risk tolerance, not a good idea for you. So, but it is, and you talked about the SEC regulations, so you have to be an accredited investor. So if you're curious, go look up accredited investor to be able to meet the threshold on it. But a lot of people in the Bay Area meet that requirement. You kind of have to in order to live in the Bay Area. So, but it's about talking to other people and finding it out. I don't know if I have anything else to add on that.
What if you're not in the Bay Area? How do you enter angel investing? So I've come across a lot of people over the last few years, people who were interested either because they'd seen headlines, or because they had a friend of a friend who had once invested in a company and had a great experience, or because they've got a nice sized portfolio. They've been investing decades now, all their lives. And thinking about diversifying into what's for almost everybody a brand new asset class. What do you do if you're not in the Bay Area?
Well, I think the easiest way to get into angel investing, probably the least risky way, is to join a group. So you've got Rocky Ventures in Boulder, you've got Valor over in Atlanta, you've got, there are thousands now of angel groups around the world, actually, not just in the US. So easy entry is, for women, there's Portfolio. So you can invest as little as $10,000 and get into angel investing and learn how to invest. But joining a group is the easiest way. I do know I have a couple of friends who made some Google money and decided to start investing on their own, and after a while decided maybe I should be leveraging the knowledge of other people in a group, because with a group comes diversity of thought, and you go, oh, I didn't even think about asking that question. And they've decided to stop throwing away their money as easily and leverage the knowledge of other people in groups. But I think there are angel groups in every state in the country, and I know that I'm familiar with some in Sweden and in France and in Barcelona, so they're around the world.
Yeah, if you're really interested in learning how to be a formal angel investor, there's a lady named Carol Sands who runs the Angels Forum. And besides running the Angels Forum, she also has a class on how to become an angel investor at Stanford. I forgot the exact class name, but I think it's literally called How to Become an Angel Investor. It's a great course. If you're thinking about going into being an angel investment or being an angel investor, you should look that up and see if that's if that'll fit in your schedule.
So this is perfect because we have one female member, one male member. There's a lot of data, right, that shows that that over time women are better investors than men. There's also a good amount of data that shows that female-founded companies perform better than male-founded companies. And Eve taking all the way from startups up to public companies with at least one woman in a senior position or in the board have outperformed over the last several decades companies that don't have women in those positions. What does that say about your approach to angel investing?
It means that if we can find companies that have women founders, women executives on the team, et cetera, then we want to invest in those companies. So it's a question of outreach. One of the difficulties that an organization, especially like ours, Tai has, and for those of you who aren't familiar with Tai, it has its roots in the South Asian entrepreneurial world, so Indians, Pakistanis, Bangladeshis, et cetera. And so the organization originally was founded back in the early 90s at a time before the South Asians became such, in high positions that we see them in today. But in those days, it was difficult for immigrant entrepreneurs to become founders. They were certainly involved in technology in the companies, but they weren't necessarily founders. And these are people with funny accents, had a hard time getting money, all these kinds of things. And Tai figured out a mentoring model that really took advantage of the talent that was coming in from South Asia. And if you look out today, I think the last stat I saw a couple of years back was 1 out of every 3 enterprise startups has an Indian co-founder. And I use the word Indian, meaning the whole South Asian diaspora. So the Tai organization's done an immense job in promoting entrepreneurship amongst the South Asians. And I think part of what's missing in with the women startups, women-led startups, is there are organizations that help promote the women founders, but for some reason they're not getting the level of mainstream interest the way that foreign immigrant entrepreneurs did, and I don't know the answer to that.
Awesome. You just set Terri up perfectly.
Well, but actually, Prashant, you bring up something that's really important, and it really is diversity. Because what we're finding is some of the most successful companies have diverse management teams, have diverse founding teams, whether it's across the board. Because then what you have is greater diversity of thought, which means your products will have more diverse aspect to it and appeal to a broader base. And so that just makes good business sense, is to have diversity in your management team, whether you are a startup or you're a big company. And I could go on for days, and we're not going to completely hijack this into why it makes sense to invest in women, because the numbers, greater faster path to profitability, greater return on investment, and also better use of capital. And that's unfortunately because there's less capital available to female founders. In terms of one of the things is there are all sorts of, one of the problems is there are all sorts of little groups, and there's really nothing connecting all of them to make it so that it's easier. So what we need to do is find a way to reduce the friction in getting access to the accelerators, the incubators, the investors who are willing to invest in female founders. Another problem that we see is women, we do ourselves a disservice in terms of establishing our vision too small. We don't think big enough, and we don't put out there the pie in the sky type thing. What we do is we make it so that because we tend to be more risk averse, which actually makes it so that we are better from a business perspective, it takes us a little bit longer to reach some of those numbers, but we tend to succeed in greater numbers. So it's more binary with male founders than it is with female founders. It just may take a little bit longer to reach that same level of success, but more of them will succeed, assuming they have access to capital. So we need to find a way either to get women to put the big dream out there, so to feel better about that, or what we need to do is have the investors realize that what the men are putting out there is not an apple to orange comparison. But there are all sorts of things that women can do differently, but also men can be listening differently and looking at investments, being more open to it and starting to check their biases at the door.
And
I'm not passionate about
like
this
that.
or anything.
I just want to know, how do you practically do that?
It's one conversation at a time, and I think right now, I mean, I've said 2017 is the year of the female, and I think with all the stuff that's going on with Uber and what's going on with binary capital and more women coming out, and even better, all of the men are coming out in support. And as long as we continue to have dialogue and open, raise awareness about it, and have more and more men acting as advocates and making a concerted effort to put more women into the funnel. Sandhill Angels, I think we've added, 10 new members this year, and not one's female. Not one. And I, as a board member, have to keep approving all of these men coming in. And we just don't have as many women because there aren't as many women who are comfortable or maybe know as much. So outreach I think is really important.
I used to be on the board of an organization called ASTIA, which some of you might be familiar with. So Sharon Vosmek runs that organization. It's a nonprofit, and I love ASTIA's model because ASTIA's model is about the community helping women entrepreneurs. It's not about women helping women or men helping women. It really is about all the stats that you talked about, Kevin, right, which is that female founders have better returns, et cetera. So if you come together, regardless of gender, it's capitalism. If I can make more money investing in a woman-led company, I'm going to do it.
Right. So I want to go back now to something else you said earlier, which is that angel investing is hugely risky. That if you don't have, essentially, I think you said, Terry, if you don't have the capital to lose, you shouldn't be doing it. So why do you invest? I mean, if this is, and do you think it's a bad investment as an asset class? If so, why do it?
You can go ahead. Why don't you go ahead and answer that first?
I think different angels have a different outlook of why they invest. The good news, so for those of you who are trying to figure out, should I raise money from angels? Should I raise money from VCs, et cetera? Or, I'm going to start with angels and then later I'm going to go to VCs. You'll find different characteristics. There is absolutely no doubt when you're going to a VC, it's about the money. It is about the return. With angels, it is about the money, but it can be about something else as well. It can be about the passion. It's, they just like the industry. They like you as a founder. They like helping entrepreneurs, whatever it is. There may be other things associated with money. They're looking, they very frequently may even have this philosophy that says, if I do the right thing, if I help the right founders and it's a company I believe in, then the money will come. And they go in with open eyes that, yes, I may lose money, but in the meantime, I'm gonna explore this journey and it's gonna be great to help watch a company grow. With VCs, that's not the case. VCs have, they're raising other people's money to get the fund, and they have a fiduciary responsibility to try to return capital to those folks, just as you would as a founder to whoever invests in your company. So for them, it is a lot more about the numbers and the return and all of these things. And I'm not trying to sidestep the issue at all. Angels do also want to make money. There are very, very few angels who will take an investment on the notion that, okay, I'm just doing it just for the heck of it. I'm just writing a check into this company.
It's not charity.
It's not charity.
It's not charity. So it's that was a great explanation. To add just a couple more things, I do it because it's fun. It's fun playing with these companies and helping, to your point, helping them grow and investing in people with these ideas and watching what it is that they're able to do, or enabling them with capital and in some sort of mentorship or some sort of support. I'm a natural connector, so I just connect, just like, oh, you need this, you need this, you need this. As an asset class, yeah, it's a risky asset class. It's a small percentage of my portfolio. It is not something, I actually look at it as, I don't expect a return. I'd like a return, but I don't expect it. Mm-hmm. The thing that's been really interesting, especially around here, is what's considered an angel investment. And I think a lot of people have forgotten what an angel investment is. And with so much money going after all of these different companies, what used to be an angel investment, a lot of VCs are in there. And so it's puffing up valuations, and it's making it harder and harder for us to potentially get really good deals on angel investments unless we get in really early. But what I see in the groups that I've seen is they want de-risk deals. So basically they want VC type de-risk deals, but they want it at angel prices. And that makes for, I think it's unrealistic from an expectation perspective. I find it really frustrating as an angel investor who sees something that has a $3 million valuation and they're raising $750,000, which is really a lot of money for angel investing, but it's what we see more often than not is $750 to $2 million with $5 to $10 million valuations, and that's an angel deal. It hasn't always been an angel deal.
Yeah, that's right. A few years ago, before I launched a company that was focused on early stage investing, we did a lot of research with angel investors trying to figure out the decision-making process. So we actually mapped out the process from first contact to writing the check, and then built a decision tree. And one of the really interesting things to us was that the motivations behind why people are investing, it was almost always not solely about the money. And one of the things we learned, or that we talked to founders a lot about, is you need to approach this process as you do any sales process. You're actually selling. And if you don't think about it as a sales process, trying to figure out how you connect with an angel, and it could be a lot of different ways, usually not the money. So let's switch the point of view then. What is it, what's the advice, given how many years you've been investing?
Startup investing 2 years, but 20 years on others.
Yeah, decades now, right? So what's the number one piece of advice that you'd give a founder approaching any angel group, yours or others?
In approaching our angel group, and probably is consistent across the board, is identifying someone who will be an advocate for you within the group. So developing a relationship with them so that they can know your company well enough that they can advocate for you within the group, and making sure that they're invested in your success, which means they're going to help sell your company within the angel group. We have somewhere between 30 and 75 submissions a month that come through. So far, as at the end of May, we'd invested in 9 new startups. 9, that's it. We had follow-ons. This year. And just this year, yeah. Which really isn't a whole heck of a lot. But it's developing that relationship. So if you're interested in a group and you don't know anybody, look for somebody in your network who can make the warm introduction, and then make sure that they are the right fit. And if not, see if they can introduce you to somebody else within the group who can then be the right fit, who can then help spread the word on why you're going to be a fabulous opportunity for them to invest in.
I agree with that. I mean, the good news is this is Silicon Valley, and if you go down University Avenue in Palo Alto, you can throw a rock down the street and you're likely to hit an angel investor. And I'm sure a lot of you have actually tried that. But I don't recommend that's a good way of meeting angels. I think these groups like Tai Angels or Sandhill Angels, I mean, there's a lot of them here in the area. Astia, the nonprofit I was mentioning, has a group called Astia Angels. So there's no shortage of how do you meet angels. But you do, the most critical thing for angels to give it a different spin on what Terri just said is to find that champion. You have to find a champion, whether it's inside of the group or somebody that you already know from your own background. So for example, if you're leaving, you're working at Cisco or Oracle and you're quitting and you're going to go do a startup, then see if you can get one of your executives to be an angel investor for you. Find someone as close to you as possible who is willing to take a bet on you. And if they're willing to do that, then you've got your first quote-unquote lead. And that goes a long way to helping spread the word. Because if you just apply kind of blindly to any of these angel groups, whether it's ours or Terry's or whoever, it's a tough thing. You're going to be competing against a lot of other companies, of which a small percentage probably already have a little bit of mind share, and that little bit of mind share then starts to explode once you start getting into that due diligence process. So try to find a lead investor, someone who's willing to make a bet, write a check to your company in your as close a circle as possible.
I want to add. And then adding one more thing onto it, this is going to sound terrible, but a lot of investors are sheep and they follow. So getting that lead investor, and if that lead investor has a certain amount of cachet or credibility, it will make it a heck of a lot easier to get the next investors. I even see that within Sandhill, is that if there's a certain person who's leading the deal, and in terms of the mind share, we have folks involved with the Battery and StartX and Plug and Play, all these different accelerators. And so they've been working with these companies, and then they come in, and so they're intimately familiar with them. So that mind share is really just super valuable. But then if they see that some other people are investing, they will automatically throw money in without really caring about the due diligence or anything else. They're just like, they've done a good job in the past. I trust them. I'm putting in money after them.
Yeah, how many deals do each of you see, say, in a quarter?
Some quarters I might see 200.
And by see, I mean in any fashion. Maybe a formal presentation, or maybe it's
I reviewed
somebody
10 decks
tonight
today.
who will come up to you and give you an elevator pitch later.
I'm going to say somewhere between 100 and 500.
Yeah. Okay.
Yeah, it's the same order.
Yeah. So,
And this is a part, I'm a consultant and an expert witness. This is just a part, the investing is a part-time gig for me. I mean, I have to fund my family. My husband stays home with the kids. So this is just a part-time deal for me.
which is true for most angel investors, right? I mean, most angel investors don't do this full time. When we were doing research with angel investors, I met somebody, I think actually a member of Sandhill Angels, if I remember right, who had a full-time job at head of a division at Oracle, and he said that his goal was to see 300 companies a week.
Is that Amit?
No. I see him all over the Bay Area, so maybe he really does hit 300 a week.
Well, and then you develop a certain amount of fatigue around it too. So you kind of have to take a break because you're like, oh my God, I've seen 10 of these before. What's new and different? And it's just like, I'm done.
Going back to your question about, you're kind of alluding to what's the secret of getting in front of angels and all this kind of stuff. What Terry just mentioned is the number one thing. It's your biggest challenge as founders is how do you stand out? And that is just an immensely difficult task for you guys to hit. And there's no easy answer for that because, we're looking at a couple hundred deals a quarter, sometimes more, depending on who it is. And when you're going through that level of screening, everything kind of feels the same. Everybody walks in with their 3 to 5 year chart and going from 0 to $800 million in, year 10 and whatever. Everyone's got this great technology. I've got a better AI algorithm and another, fruit of the day and whatever and stuff. It's really, really tough. It's tough. And then I don't mean for us. I mean, it's hard enough for us to figure out where we're going to invest, but it's tough for you guys to stand out. And so it's not going to happen on your pitch deck. You got to figure out that networking. You got to get that first lead. You got to work the network, the system, all of that kind of stuff to try to get mind share. It's all about mind share.
And to add on to that is if you're going to be meeting with a certain investor, whether it's VC or if it's an angel, do a little research so that you understand, so you can develop that rapport very quickly. Because we see so many, we're looking to get to know as quickly as possible. We're not looking to get to yes. We're trying to screen out everything as quickly as possible. And so if you make an effort, I was being interviewed earlier and I was asked about a story about, being an angel investor. And I was looking at this drone company. I was really hot into drones last year. And I was talking to this person and I asked some questions about the regulations. And he started completely mansplaining to me about FAA regulations. And I had to say, well, as a commercially rated helicopter pilot, I'm intimately familiar with the FAA regulations around that. And he goes, oh, we should have known that. And I said, yeah, you should have known that, because then I mean, it was just like cross you off the list, you're done. So get to know a little bit, make a little bit of effort, differentiate, because we do see a lot coming through. The last thing you want to be is arrogant. The last thing you want to do is piss off the person you're trying to get money from. The greater level of transparency and willingness to share and cooperate is, for me, is really, really important. Others appreciate arrogance. Others appreciate, so it's all, every angel investor, every VC is going to be a little bit different in terms of what they look for. But pissing off an investor is probably not a good way to get to their checkbook.
This is back to this being a sales process at the end of the day. Exactly the same approach you would take in selling it into an enterprise, for instance. Similar story here.
Oh yeah, very targeted and not doing a shotgun approach. So making sure that they potentially will be investing in your particular area, so you're not wasting your time and you're not wasting their time.
Right. So think about some horror stories. What is the most common, let's call it mistake, screw up, foolishness that you see a founder do or an error they make?
There's a zillion things that can go wrong.
There are.
I mean, it's just so hard to pinpoint. Yeah. I mean, so I think I think it's a repeat of my last comment, which is the lack of differentiation. There's hardly a space out there today that doesn't have at least 50 startups in it. I mean, just pick any space you want, and there are probably 50 startups that are attacking that specific market. And it doesn't matter whether you're talking about AI, some new consumer refrigerator, some new gym shoes, just whatever it is. There's so many startups, and it's so hard to find white space, as it's known in the industry, that the ability for startups to differentiate and truly point out what's unique about you. And by the way, uniqueness doesn't necessarily mean that it's your product or your technology that's unique. If there's something outstanding about you as founders, I mean, that team uniqueness is very important as well. And for angels especially, Terry's talking about making, getting to know someone and developing a champion and all these things. That's really critical. How do you as a team stand out? Because that's the first thing, especially in the angel world, that's the first thing that you get evaluated on is you as a person, as a team player, as a founder. And it starts with the team before the angels even start looking at things like technology and market and all of those kinds of aspects of your business.
Yeah, because if it works out, you're going to have a 10-year relationship, right?
So one of the things you just, I wanted to interrupt and say, saying there's no competition, you're the only one. That's probably one of the biggest mistakes. And it's like, okay, eliminate, that's probably one of the bigger mistakes. One of the things, going back to developing a relationship and collaborating, if I've received an introduction to someone and I'll say, hey, send me over your pitch deck so I can take a look at it and make sure that I understand who to forward this off to. Because I can't lead every single deal that comes through, that comes into my inbox. I have had a couple people who have said, no, I don't send pitch decks. And I know Gil Pancina, he and I were on a panel at 500 Startups, and I think he and I disagreed on absolutely everything, because he's like, don't send pitch decks. And I'm like, I won't take a look at it if you don't send me a pitch deck. Don't send pitch decks. I'm like, fine, don't send me a pitch deck. I'm not forward, stop, you're done. Right? Yeah. I don't get to at least take a look at it and sanity check and make sure that it seems like it's a possible deal. And then arguing with me about that is, it goes back to the collaboration. And, I'm a typical female. I want to help. I want to see you succeed, and so if you make it so that it's difficult for me to be able to do that, then it makes it challenging, and then it sets the wrong tone for this relationship for the next 7 to 10 years.
I think that's a good way of phrasing it, Terry, is what you said earlier. The biggest mistake that I think entrepreneurs make is not knowing who their potential angel is. Right? So it goes back to not knowing that Terry's a helicopter pilot, so she understands FAA regulations inside out. It's not understanding that I don't invest in consumer, so coming to me with a consumer idea is just not going to make sense. Or if you're pitching someone a life science idea and they're not investors in the life science area. But even more than that, right? Most of our profiles are on LinkedIn. Our bios are on our respective angel pages, probably your company page as well, et cetera. So you can get a pretty good sense of what that person is interested in, what they're not interested in, what they know, what their expertise is, et cetera. And so when you go to them, go to the angel and not only figure out who would be a potential angel for your company, but figure out what's the value add that you can get from them. So if you go to them on this notion of, look, I want your expertise. I want your money, of course. That's why I'm here. But I want your expertise because you're an expert in marketing to enterprises or sales to small businesses or whatever it is. And if you can get it down that precise and segment your market for investors, that'll help you.
Oh, and to add on to that, then that'll appeal to the ego of the investor as well. As you're basically saying, hey, I see that you're an expert in this area and I really want your help. Would you, can we have a conversation and talk about how you might be able to help my company? So appeal to, all of these people, all of us have big egos. Appeal to them. And with technology, it really is so easy to find out just the little bit of the ittiest bittiest piece of information. Some of us are out there all over the place, but it's going to the sales. It's definitely going to the sales cycle. So knowing who your customer is, a little bit about them, so you can change that cold prospect to a very warm prospect. It will make it a lot easier to continue down that funnel.
Like the old saying, ask somebody for advice, and you might get money. Ask for money, and you'll get advice, right? So if let's say I've started a company. We're going to be looking for capital. How do I figure out how much I need to raise, when I should be raising funding, and what potential investors are going to want to see from me?
I'm going to be flippant here. So figure out your timeline and double it. Figure out how much you need, double it. Figure out how long you're going to need that money for, and double it. That's the project manager in me, because everybody underestimates. I'm going to let you answer the rest of the question.
Thanks, Terry. There's a really, really good book that I like. I think they might be in their second version now. It's called, it's an O'Reilly Media book, and I think it's called Lean Analytics, if I remember correctly. I recommend you guys at least flip through it. It's a good read, but it gives you a really good framework for thinking about metrics that matter. And one of the critical things in that book is that at different stages of your company, different metrics will be what drives your company for that stage. So early on, it might be something about getting beta users. Later on, it might be about how the beta users actually went through your funnel process. And after that, it might be something else altogether. Once you actually start selling product, it might be more about lead gen, or it might be about marketing, or whatever it is. But it gives you kind of a way of thinking about what are the metrics that matter for your particular stage of the company. So when you think about how much money do you need, you should have a good understanding of what are the metrics that are driving your company at the stage that you're asking for that money, and then how the amount of money that you're asking, what metric will it drive you to? What's that milestone that you're looking for? So are you trying to get, and this isn't just like the vanity metrics of like, hey, I'm trying to get to 1 million users or some such thing. It's more about what are you trying to discover with the money for that round. So for example, I know today that it takes me 5 touch points to convince a user to sign up for beta. I have to first reach out to them on Facebook. I have to get them to my landing page. I have to convince them. I have to do a couple more retargeting ads, et cetera. Eventually, those 5 touch points, I will get 10% of those users to become beta. So maybe the money that you need is to be able to figure out how to drive that ratio more effectively. And so you have to kind of come up with, well, how much do I need to spend to get from 5 touch points down to 3 touch points, or to move it from 10% of those users signing up to whatever it is. So think about those kinds of things. And there are analogies like that in every business, whether it's a life science company or an enterprise technology company, or what it is. Are we getting the boot?
I think we're on with the Q&A.
Oh, Q&A.
Yeah, so, and that's a very bottoms up approach to defining how much money that you need. And there are different ways that you can do it. Going back to one of your questions, one of the things that founders don't do is we'll always ask, well, what are you going to do with the money? And how long is it going to last you? And, are you going to need to do another round? And if so, what's the criteria? What are the milestones? What are the metrics that you're going to need to hit in order to get to that space. And if you have a smart investor who's really looking at doing some due diligence, they're going to dig down into it, find out what your assumptions and your premises are in order to get to that. Because a lot of people come into this and they're technologists, but they're not necessarily business people. And you have to have some business savvy, knowledge, expertise on your team. You can only luck into it for a certain period of time. If you don't have it, then you would definitely need it from an advisor perspective. Otherwise, you're just going to randomly hit stuff and not have any really real sense of it. The other thing that we see, I want to do one more thing on that, is I think last year I was at launch and somebody was talking about how there's been a shift in terms of stages of business, and you talked about stages of business. Your stage of business is not based on your funding round. Your business
Really?
Yeah, I know. I think some people have completely forgotten. It's kind of like angel investments, but your business is not based on your funding round. The maturity of your business and the success of your business is based on other criteria and not on how much you have raised.
It's a good way to end.
Don't be delusional.
So we have some time for questions and to anybody on the panel. You, sir, in the back.
Hi. Sorry I was late. How far up the pipeline do you invest, from seed to A or seed, super seed, A? What's the range of checks you do?
What's the definition of each of those now?
I mean, for where you see it today, I mean, compared to like, I'm coming back to the Valley after 4.5 years of being gone, and everything's changed. So, yeah, it's like another world.
Yeah.
Well, and geographically, it's different too. So it's not just here.
But for here, like, what's your range of check and of your checkbook size, and what do you invest in terms of, on the panel, each of you, like, you're doing 50K, you're doing 500K, you're doing 2.5 million, in terms of your investment point, and then do you have enough big enough checkbook to be able to do the next follow-on investment, or are you then partnering upstream with other folks?
That's a really good question. So I'm looking at global opportunities. So I'm really taking a look at not only what's happening here, but other places. And the definition of pre-seed, seed, post-seed, pre-A, whatever, it moves. It's really, really crazy, actually. My very first investment, I invested in a Series B round. Sandhill Angels had invested in MyHealthTeams. I came in and said, I want in. My average check size is only $10,000. But I just threw in another 10 into them for their Series C, but that's relatively unusual. Usually we're coming in at Sandhill, they're calling them seed rounds, or maybe pre-seed. Once again, it's different for every single one. And then usually the follow-ons with the groups, since our group members change, the same people who invested initially may not still be around for the subsequent rounds. But what's really great about that, as long as we have pro rata built into the initial investment, some of us can get into investments on the subsequent rounds. So I've tripled down on Sandstone Diagnostics. So I put 10 in, another 10, I'm 30 grand into Sandstone. And I don't think they've raised their Series A yet. They've just done a bunch of pre.
At Tai Angels, our average investment into a company is around $200,000. We've ranged anywhere from 25, 50K if only one or two investors are interested in the company, all the way up to north of $1 million if it was a really wildly popular founding team. But the average tends to be about $200,000 when we invest, and that's usually scattered among anywhere from 5 to 10 investors, something in that range. I think you asked about follow-on rounds as well, or how do we bring them to the next thing. I mean, part of what we do is we try to make introductions for their venture rounds. We actually, I don't know if you were at Sandhill at the time, but one of the companies that came through our accelerator was a fintech company called Swipe or Quiver, and Sandhill, that was before. Steve Bennett was the person who drove that one. So Tai Angels, plus the Tai Accelerator, plus Sandhill Angels, and a few others got together and put that round together. We ended up doing the seed round together with angel groups, and then they subsequently raised money from Khosla Ventures and some Japanese banks for their Series A. So collectively, as formal angel groups, the good news is that it's in our interest to really try to help the companies and help them get to the next round and introduce them to upstream investors.
So at Sandhill, I keep going to me and not the group, and you keep going to the group. So anyway, our minimum check size is $50,000. We have to have at least 3 investors interested in the deal. The highest I've seen was $500,000. The average, if you look at across the numbers, it's somewhere between 100, 130,000. In taking a look, with some few exceptions this year, our average investment has been about 60,000. So it hasn't really been very much, with the exception of 2. But those, one was the president was the CEO was a Sandhill Angels member. Super warm intro on that one. And the other one, it was a cannabis type thing, and a bunch of people must have gotten stoned and thrown in a whole bunch of money on that one. The other things, and you've probably been watching some of the trends, the angel investing seems to have died down a little bit this year across the board based on some article I read recently, which is we've had a lot of follow-ons. And what's also very interesting is Sandhill Angels, we also invest in funds. I don't, because I want to play with the companies, but there's been a lot of investing in funds, which allows investors who wouldn't necessarily have the ability to get into some of these funds, gives them as a group the ability to get into those funds. So did we answer your question at all about what we invest in, when we invest, how much we invest?
Very much so. Just it sounds like you get involved in an advisory role with some of the startups, and to what capacity is that? Quarterly or monthly role that you come in to sort of?
Are you talking about me or across the board?
Yourself, in terms of doing a checkup with the founders and what's going on?
So yeah, the way that we have it structured at Sandhill is we have class managers who are the liaisons with the companies. So I'm now class manager for MyHealthTeams. Earlier on in the year, I was getting together on a monthly basis with the COO. They've been incredibly busy. I've been incredibly busy, so now I'm getting together every 2 to 3 months, but we get monthly reports from them. And she and I are on Facebook and on Twitter, so we try to communicate that way. One of them that I just invested in, I'm trying to get onto their advisory board. Good news, she lives 4 doors down from me. And that's one that I did a direct investment in because I couldn't get sufficient interest from Sandhill. And what's really ridiculous, it was $1 million raise, $3 million valuation, priced round. Launchpad Digital Health, Plug and Play is in there. I mean, somebody from J&J is in there. It's a digital health. I mean, it seemed to me it was a no-brainer, and it goes back to the angel. Some of our angels seem to have forgotten what angel investments are really all about. But yeah, I want to play with some of these companies. Some of them I have more time for than others, but other people may be class managers and may be getting updates more regularly.
Thank you.
Good question. Thank you. Yes, sir.
So for the amount that for the range that you're funding, what kind of equities or discount are you looking for?
Usually, most of the companies that come in are in the single-digit caps. Almost all of them are notes, by the way, so just to kind of answer the unasked question. Most of the founders come in today with notes on the table, and we're okay with that.
Sorry, convertible notes.
Convertible notes, sorry, yeah.
Not safes or not equity.
Not so much. Not so much. We're not seeing a lot of safes. I mean, every now and then a company with a safe will come in, but right now most of the companies that we see are still doing convertible notes with a cap, usually in the single-digit millions, depending on what the founders think they can get away with. 5 is kind of mid-range, and then 20% discount. That's kind of like if you said, here's the average, it's kind of like that 5 million cap, 20% discount.
We're seeing just massive variety. I think I saw one come through with a $26 million valuation. I'm like, why are you coming into an angel? Yeah, I think they were raising 5 to 7 million. I'm like, this is not an angel deal. And the first question that I ask is, why are you looking at angels? And they'll say, well, we want access to the network and the research. And we're just like, don't freaking waste your time, especially with an angel group that may be putting in 50 to 150,000. It's not enough bang for your buck, frankly, if you're trying to raise that amount of money. I reviewed, 5 or 10 decks today, and a third of them were safes. And we generally shy away from safes because oh God, now I'm gonna forget. There is a priced round option. It's called the Series Seed, and it's only like $25,000 to do it. We're actually pushing founders towards price rounds so that we have a clearer idea of actual ownership in it. And the ownership is really going to be dependent upon the number of members who are willing to throw in money behind the deal. So we don't have really a target percentage because we don't have full control over membership because we all put in different amounts. And then some angel groups may have a fund. We don't have a fund. So if 5 of us put in, we're the 5 who are either going to win or lose on that particular deal. So it's not shared risk and it's not shared benefit on it. But yeah, we have a couple of people in our group who really advise on the various different notes and stuff, and are advising away from safes. We're starting to see more uncapped notes, which we then go back. Uncapped, we then go back and try to negotiate on. It used to be the 3 to 5 million. I mean, even just a year ago, 3 to 5 million was the normal. Now we're starting to see that 5 to 10 seems to be the normal valuation. My first question is, what the hell are you basing this on? Mm-hmm. You're not even in, you have a prototype, you have no IP. What are you basing, what are you basing this on?
Yeah. This is something that's fluctuated a lot over the last 5 years or so, and both the instrument being used. So maybe 5 years ago there was kind of an in the U.S. an East Coast West Coast debate between convertible notes and priced rounds, and there was sort of a declaration of victory that convertible notes had won, and generally everybody in the tech world in the United States, but only on the coast, was comfortable with convertible notes, and really only on the coast. I sometimes say that in the United States, from an investing point of view, the Midwest ranges from about Sacramento to Philadelphia and the Canadian border to Mexico, because that entire group of investors has taken the same tack, meaning that for several years they wouldn't do convertible notes, and they had looked for very different terms. But in Silicon Valley, I think we've really seen a lot of fluctuation. Safes were really on the upswing, and if you don't know what safes are, it's something that a couple of groups or a couple of some law firms and investment firms came up with a few years ago to really kind of solve the problem of convertible notes. Convertible notes are really treated by investors as equity. I think nobody is investing in a company because they want to clip coupons. But the convertible notes are structured the way they are. They're structured as debt for tax and legal reasons. Safes were an attempt to get rid of that debt side and create something. It's essentially an option, so it's an equity. And I think it stands for Simple Agreement for Future Equity. I don't know who came up with that, but was it YC?
YC.
Yeah, YC came up with the name. And that seemed, maybe 2 years ago, it seemed like everybody was proposing safes. I've seen the same thing this year, a real rebound against safes, back to convertible notes. And maybe for those who were at convertible notes before, looking to priced rounds, much more than was true a year ago.
Yeah, that 1 on 3 was a priced round. I absolutely loved it.
Right. Yeah. It's if you're, I would say, I don't know if you would agree, but I would say if you're looking for an early stage investment, you're going to get better feedback if you're willing to do a priced round, even at a seed, pre-seed, whatever the hell we call it.
One more question, and then we finish.
Yes.
So if you're in the elevator pitch or pitch deck, is it better to sell the long-term vision where your company is going, or what you have right now and you're going to sell in the next 3 to 6 months? And my second question is, does the incubator operate at the same level as the angel investor, or is it pre-angel or post-angel, or is it varies from incubator to incubator?
Do you mean incubator or accelerator? Those are two different. Oh.
Yeah, that's a good point. Can we answer the first question, and then we can go to the second question?
Okay, so elevator pitch and pitch deck are actually two different things as well. So if someone's trying to pitch me on just an elevator pitch to attract my interest, it's usually the longer term vision, because you're doing it in like 2 minutes. So you have to tell me why you're changing the world. So I'm like, ooh, tell me more about how you're doing that. in the actual pitch deck, I expect to see both. I expect to see what do you have now, why is it that you're special and you're different, who your competitors are, but then how, is it a one and done type thing, or is there a longer strategy? Because I want to invest in something that has a longer strategy and it's not just a one and done.
The other question that you asked was about accelerators versus incubators, et cetera. The main difference between the two, and the terms are very much used interchange today, but I do think there is a
you're
difference.
not the only one.
Yeah, it's not. It's a very common question. Even the media does that. They say incubator versus, especially. You can't trust
Sometimes
the media.
even the incubators and accelerators.
They do. They completely do. The main difference between the two really is that most incubators are real estate based. So they're going to charge you rent, they're going to charge you office space, they're going to charge you things like that. And then the services for introducing you to investors or mentors, all those things are additional price, whether they're priced as cash or priced as equity or whatever it is. It's a smorgasbord of services that they'll offer you. Accelerators, the idea behind an accelerator generally is that it's programmatic. It's 2 months, 3 months, 1 month, whatever it is. And during that time, they are going to expose you to some very intense ideas about entrepreneurship, everything from how to think about your product or how to think about selling, how to meet investors, how to craft your pitch deck, how to do communications, better speaking, better engagement, all those kinds of things. And each incubator, even I'm doing it, each accelerator will have a different slant on what they're pushing. And then you asked the question of how are these terms similar for accelerators or not? The accelerators will generally take some kind of equity as part of the fee for joining the program. They may or may not also invest in your company. And if they do, it's a token investment anyway. So it's not about the money. It's really about, do you value the services that you're getting from that accelerator? Even if you're in an incubator, you still have to value the services. You have to decide, is it worth it for me to give up 1% in order for that incubator then to put me in front of a bunch of angel investors or customers or whatever it is? And some do a great job. Plug and Play does a phenomenal job. This is why there's 600 companies in those offices down in Sunnyvale, because they make fantastic introductions. If you're a fintech startup or if you're a healthcare startup or whatever it is, and they charge you equity for all those things.
Let me add one more thing. And those introductions, I'm just going to say be wary of some of those introductions, because some of them are are consultants cloaked as mentors. And so they might give away 15 minutes of their services, and then they expect to sign you up for $30,000 worth of services. So it's really important, if you're looking at some sort of an incubator or an accelerator, to understand what those introductions really are, and talk to other people who've gone through it, because I've heard of a couple of horror stories from some founders who expected to get those introductions and have services available free of charge, and then had to either opt in or just go look for the services elsewhere.
Or worst case scenario, got a bill that they didn't know how to pay.
Well, and I've seen that too, where they didn't realize that there was a service fee on top of the accelerator agreement and didn't find out until close to signing, and then all of a sudden they're on the hook for something for a 12-month period, and it's not uncommon.
Great.
We can't leave on that negative note. We got to say something positive here.
I'm going to say something positive. I wanted to thank you all. I love the equation for this comparing an entrepreneur pitching to sales, and I've never actually put that together, but that's why I love organising talks like this, because I've learned so much, even though I've been here so long, and I'm sure everyone else does, and that's what the value is of what I'm providing, bringing people like you together to educate us. Thank you so much.
Well, thank you for the opportunity.
Thank you.